Hello friends, welcome back. In this session, we are going to discuss about the other option strategy like the bearish and the neutral or the range bound. As I mentioned earlier that option strategies are the combination of buying and selling, or sometimes it's all about the writing and hedging. So ultimate aim is to customize your own setup as per the market view. Friends, 90% of the business is happening into the index option side, and out of that 30 to 40% participants are turning into the option strategy. Recently, after the lower margin on the hedge option strategy, participants are more shifting into the strategy side rather than buying and the naked selling. So today we are going to discuss about the bearish strategy and the range bound neutral strategy. My name is Chandan Tapadia. I'm in technical and derivatives field from last 1 decade. Regular prominent face on all the business channel, writing for Economic Times, Business Standard, Financial Chronicle, Financial Express, and also share my thoughts to many viewers and the readers by Money Control and ET Online. So let's begin now. So we will talk about the option strategy in the bearish side. So first, the bearish means you are having the negative view on the market. You are expecting market to go down and you are customizing a strategy which give you the better risk reward ratio. If market moves up, you are not going to lose much, but if market goes down, you are going to make better. So here we will discuss about the three kind of strategy. In the negative side, the bear put spread, bear put ratio spread, and bear put ladder spread. See, almost all the strategy are somehow the extended version of each other, but the aim is just to get better risk reward ratio and how to deal in the different scenario when you are trading at the beginning of the expiry week or expiry series, or when you are trading near to the expiry week or expiry series. So first we'll start with the bear put spread. So bear put spread is just opposite of the bull call spread. When we discuss on the bullish side, we learned about the bull call spread, that was the combination of buying a call and selling one out of the money call. So bear put spread is opposite of the same. We are having the negative view. We are expecting market to go down or particular stock to go down. We are buying a put and we are selling out of the money put to reduce the cost of our buying put, and at the same time our market view is we are expecting negative move but limited on the downside. So ultimately the view is negative to range bound. We want to pay the less premium and we are okay with if we are getting the lesser reward. So first, if I compare with the buy put and the bear put spread, in the buy put that is only one leg strategy. We have to select the strike. Market view is negative. If market goes down, we'll make money in the buying put, but if market moves up, we are going to lose the entire premium of that particular put. So now if we shift to the bear put spread is buying put but adding one extra selling out of the money put. So the aim is to get the benefit of premium of out of the money put because we are expecting the limited downside in the market. So advantage is lesser premium to pay comparatively, because if we are buying a put, we have to pay more compared to entering into the bear put spread where we are receiving some premium also by selling one out of the money put. Risk and reward is predefined. Bear put spread, like the bull call spread, is a limited risk, limited reward strategy. We know how much risk is there in the strategy at the beginning of the executions and how much reward we can get out of that. Positive view, positive return if market get on the negative side, negative to range bound side, risk is reduced. Also the break even. Now disadvantage is the profit is limited. Let's say we initiated a bear put spread and market corrected by 300, 400 points, and we initiated a bear put spread of 200 points. We are going to get profit much to that pair and the range of the one strike to other strike. Even if market corrects by 10% further to that, we are not going to make money from that. So it's a limited reward strategy. When one expects negative to range bound move, then only advise. Why this strategy? To reduce the costing of buying put, and we are having the limited downside for the person who are looking to pay very less premium, but at the beginning of the series or beginning of the week premium is high. So this is the only way to reduce the premium. So many times people buy the puts and they buy the out of the money put because premiums are less. But one need to remember, when we are going with out of the money puts, premium might be less, but probability is also less. So when we are turning into the bear put spread, it provides us a benefit that you can reduce the premium by shifting of buying one put and selling one put. So this is just adding the advantage of giving lesser premium, comparatively favorable break-even point, and downside to range bound movement as well. So look at the practical exposure, and then we'll go to the analysis side to find out the real examples. So bear put spread means negative to range bound bias. Let's say in this example, your Nifty future is trading near to 12,000. You are buying 12,000 put and selling 11,900 put. So bear put spread is buying one strike. Here we are taking at the money buying put and selling slightly out of the money put. So when we are buying one put, we have to pay the premium, but when we are selling one put, we receive the premium. So I'll just take to the Excel file to tell you about the strategy calculator, how exactly it works, and how much the payoff can be identified from the different strikes. So that will be easy for the person who are working to the naked options and they want to learn to the customized option strategy. So we are working on the bear put spread. So in this example, we are buying 12,000 put, premium is 100, we are selling. So first I'll show you how exactly only buying put works, and then different scenario for those conditions. So if I'm buying 12,000 put at 100 rupees, my break even is 11,900. Now let's say if market goes to 12,100. If market goes to 12,100, I'm going to lose 100 rupees. Now in the other, if market let's say goes to 11,800, I'll be making 100 rupees. So this is how the only naked buying options works. Now I'm just removing it and converting into the bear put spread. I'm buying 12,000 put. I'm selling this example of 11,900 put at 60 rupees. So this is 11,900 put and the premium is 60 rupees. So if I look at the combined break even, that will be different than the individual break evens. 12,000 put I'm buying at 100 rupees, my break even goes to 11,900. If I'm selling 11,900 put at 60, my break even will be 11,840. Now, if you look at the combined break even, so combined BEP will be the total premium which I paid will be 40 rupees. My maximum risk will be 40 rupees. Combined break even will be your 12,000 minus 40, 11,960. My maximum risk will be 40. My max reward will be 60 points. Now, if I look at the different scenario, if market let's say goes to 11,700, it goes to 11,700, I'll be making 200 rupees in this because I bought 12,000 put at 100 rupees. My break even goes to 11,900, and markets is near to 11,700, settling at 11,700. I'll be making 200. But I sold 11,900 put at 60. My break even is 11,840. So here I'll be losing because market has gone much lower than my break even, and I sold the put. When I'm selling a put, my view is positive, but if market goes down, my risk is unlimited. When I'm buying a put, my view is negative. If market goes down, I'll be making money. So if you look here, net to net, I'll be making 60 rupees. And if you remember, my maximum reward is 60, whatever the downside market goes. Similarly, now let's say if I take the example of if market goes to 12,400, if it goes to 12,400, I'll be losing 100 rupees here, but I'll be making 60 rupees here. Net to net, I'm losing only 40 rupees. So this is how the concept of the bear put spread works.
Register for our free webinar. Download our app today. Link in description.